This is a video for the continuation of our April 3rd class presentation on some of the different aspects of audit reports that are issued by a CPA. We still have a lot of material that we need to cover, so this is going to be covered pretty much in this video. And we're going to talk about audit reports and placing what we call an emphasis of matter paragraph in an audit report. Also, we're going to talk about audit reports where we place what we call other matter paragraphs in the audit report. We're also going to talk about something we haven't really talked about in our audit subjects yet, but the word is pervasiveness. And we're going to talk about pervasiveness as it's applied to audit opinions. It's a very important term. Just as we talked about materiality is a very important term, pervasiveness is also going to be a very important term, especially as it applies to audit opinions. We're also going to talk about audit reports where we have qualified audit opinions and audit reports where we have adverse audit opinions. So let's go ahead and get started on what we would call a audit report where it is a unmodified audit report, but for some reason we're going to insert what we call an emphasis of matter opinion. Now, an emphasis of matter paragraph in an audit report follows the opinion paragraph, so it goes after the opinion paragraph and is included to refer to a matter that is appropriately presented or disclosed within the financial statements, but for whatever reason it's being emphasized by the auditor through the audit report. Now we have some examples of this, okay, such as the uncertainty relating to the outcome of important litigation or regulatory action. A major catastrophe that has or continues to have significant impact on the entity's financial position. Significant transactions that can occur with that occurred with related parties. Any important subsequent events to which the auditor wants to refer separately. And lastly, if the auditor has substantial doubt about the entity's ability to continue as a going concern. So these are examples. Now these are not the only examples, but I just wanted to point some of them out. Now, audit standards do require the auditor does insert an emphasis of matter paragraph under certain circumstances, and there are 3 circumstances cited in the standards. If the auditor's opinion on revised financial statements changes after the original report date, that fact should be included in the emphasis of matter paragraph. Number 2, if there is a going concern issue with the company. And number 3, a material change in principle or the correction of a material misstatement in previously issued financial statements. Now, when we are going to insert as auditors, we're going to insert an emphasis of matter paragraph. We do need to notify those charged with governance regarding the inclusion of an emphasis of matter paragraph, and that sounds pretty that sounds pretty obvious, but the standards do say that those charged with governance need to know that before it comes out. Now, the emphasis of matter paragraph should be titled as the emphasis of matters or some other appropriate title. And here we also see that the emphasis of matter paragraph should appear immediately after the opinion paragraph. So we have our opinion first, then the emphasis of matter. So uh, in this case, we can read this audited opinion, and it's basically an unmodified audit opinion, and it says, in our opinion, the financial statements referred to above present fairly in all material respects the financial position of ABC Company as of December 31st, 2000, and X1, and the results of its operations and cash flows for the year then ended in accordance with the principles generally accepted in the United States. Okay, in the emphasis of matter disclosure paragraph example, it says, as discussed in Note X to the financial statements. Now, as part of the emphasis of matter paragraph, you need to include in the paragraph a clear reference to the information within the financial statements where the relevant disclosures fully describe the matter. In other words, you don't have to describe it totally in the emphasis of matter paragraph, but you do have to basically refer to where that item is in the financial statements. So as discussed in Note X to the financial statements, the company is a defendant in a lawsuit, and then the job of the auditor would to be briefly describe the nature of the litigation and make sure it's consistent with the company's descriptions in the notes of the financial statements. Now, the other thing is at the end of the emphasis of matter paragraph, the auditor needs to add an additional sentence, and it says, our opinion, meaning the audit opinion, is not modified with respect to this matter. So the auditor needs to include a statement that the auditor's opinion is not modified with respect to the matter being emphasized. Okay, now let's go on again. We're going to see another type of paragraph, and it's called, and for an unmodified opinion, and it's called an other matter or other matters paragraph. And in this case, again, the auditor, it refers to a matter other than those that are presented or disclosed in the audited financial statement. So in this case, the other matter paragraph refers to something that is not obvious in the financial statements. The matter and then the conditions basically that it occur, or that the other matter paragraph would occur, is that in the auditor's judgment, basically the other matter is relevant to the user's understanding of the audit, relevant to the user's understanding of the auditor's responsibilities or the auditor's report, and the last item is relevant, basically reporting on more than one set of financial statements. Now, here I have some examples of where one would use an other matter paragraph. As an example, report on comparative statements when there are predecessor auditors. Alert readers about the intended use of an audit report when it's not for general use. When financial statements have been prepared on the basis of special purpose frameworks, such as other comprehensive bases of accounting. If the auditor's opinion on revised financial statements changes after the original report date. Material inconsistencies in the other information presented all along with audited financial statements. The auditor may also report on supplementary information in relation to the financial statements as a whole, or the auditor may report on required supplementary information, and reporting on compliance with certain aspects of contractual or legal requirements. And just like the previous other matter paragraph, the auditor must notify those charged with governance regarding, this should say the other matter paragraph, not the emphasis of other matter. Okay, then we go down to the audit opinion and notice The other matter paragraph should normally appear immediately after the opinion paragraph, and notice that I do have a title for opinion, and then immediately after I have a title called, it's appropriate, called other matter. So in this case, again, the audit opinion is in effect an unmodified opinion saying that the financial statements are basically fairly presented. Then I get to the other matter paragraph, and the other matter paragraph says this report is intended solely for the information and use of in this case specified parties. So this comes under the condition in this case where we talk about when financial statements to alert readers about the intended use of the audit report when it's not for general use. So in this case, this report is intended solely for the information of use of specified parties. It is not intended to be and should not be used by anyone other than these specified parties. Now, again, very importantly, at the end of this paragraph, the auditor has to insert this statement. Our opinion is not modified with respect to this restriction. So the auditor saying, even though that we have this particular, we pointed out this particular item, there is no modification as to our audit opinion. Okay, now let's go on and look at what I would call the 10,000-foot overview of what we just talked about in terms of emphasis of matter and other matter reports for unmodified opinions. Okay, when we're talking about the emphasis of matter report in terms of when we're looking at its relationship to our financial statements, we know that the issue itself has been appropriately presented or disclosed in the financial statements. On the other hand, if the item was not presented or disclosed in the financial statements, we would include that in an other matter paragraph instead of an emphasis of matter paragraph. Okay, now in the case of what standard would the auditor use for creating the emphasis of matter paragraph, and that would be if basically it has to be fundamental to the user's understanding of the financial statements. If it falls under the category of other matter paragraph, it has to be relevant to the user's understanding of the auditor's report and or responsibilities. Okay, now let's look at several questions pertaining to other matter type and emphasis of matter in unqualified reports. Let's look at several questions. So question number 12, we start off with Miller Corporation, which was involved in litigation regarding the company's alleged infringement on a patent. The product in question is Millard's primary product. In other words, the reason they exist. The subject matter of the litigation was disclosed within the notes to the financial statements. Taken as a whole, the financial statements are fairly presented in all material respects. The auditor would most likely render which of the following types of audit opinions. And you're given your 4 choices. Go over and ponder the correct choice, and as you're doing that, stop the video, and then when you're ready to view the answer slide, please restart the video. Okay, let's go ahead and review the answer. And to 12, the question is, again, the auditor would most likely render which of the following types of audit opinions. And in this case, the answer would be B, unmodified opinion with an emphasis of matter paragraph explaining the potential impact of the litigation on the company and its future operations. And when we look at this, basically what the body of the problem says is subject taken as a whole, the financial statements are fairly presented. So what that would mean is that would start out, that's going to result in an unmodified opinion, so we can rule out item A and C because they don't contain unmodified opinions. So B and C are the only two items that could possibly qualify. Now, if we take a look here, the difference between the two is basically one is an emphasis of matter paragraph and the other one is an other matter paragraph. And if we remember back to our previous PowerPoint slide, we would use in the event the emphasis, or in the event that the matter is disclosed in the financial statements of the company, we would describe or refer to that in the emphasis of matter paragraph. So the correct answer in this case would be B. And as I say here, emphasis of matter paragraph is normally used when the auditor wants to call the financial statement reader's attention to a significant item which has also been disclosed in the financial statements. And if it's been disclosed, that automatically rules out D. Okay, let's try question number 13. Again, kind of a wordy question, but the auditor has audited the financial statements of Fillmore Corporation and has found the financial statements, again, taken as a whole, to be presented fairly in all material respects within the applicable financial, in effect, reporting framework. During the audit, the auditor noted that inventory represented 70% of Fillmore's total assets on the balance sheet. The auditor also noted the inventory being sold was subject to a technology that could be obsoleted overnight if a new or substitute technology became available. So the auditor, but at this point in time, the auditor has no indication that such a new or substitute technology exists, at least at the present time. So the auditor most likely would use which of the following audit opinions, and again you're given four separate answers. Review the answers, and when you make your selection, and then go ahead and stop. As you do that, stop the video, and then when you're ready, go ahead and restart the video and review the answer slide. Okay, let's take a look at the answer to question number 13. And again, the question number 13 is the auditor most likely would use which of the following audit opinions, and the answer in this case is A. The auditor would issue an unmodified opinion with an other matter paragraph explaining the uncertainty of the inventory valuation. Now again, when we look at this, what the body of the question says is that taken as a whole, the financial statements are being presented fairly in all material respects within the applicable financial, in effect, financial reporting framework. So that means we're going to be issuing an unmodified opinion, so that automatically rules out answers C and D. So we have the difference between unmodified opinion with an emphasis of matter paragraph or an unmodified opinion with an other matter paragraph. And again, if we remember going back again to our initial presentation, we said an other matter paragraph is when the auditor wants to point out something that is important as a result of the audit, but that information is not referenced in the financial statements themselves. So that would fall under the other matter paragraph. If the information was inserted or located within the financial statements, the auditor would normally issue an emphasis of matter paragraph. And as I say here in the explanation, Fillmore's financial statements are fairly stated taken as a whole, as we talked about. However, the auditor wants to point out the fact that Fillmore's inventory could be obsoleted overnight. They want to point that out, but there's no reason to say it is, because there is no indication that there's been this new technology implemented or invented. Since the financial statements are fairly stated, the auditor would select an unmodified opinion with another matter paragraph. This is because the auditor would want to point out the susceptibility of the inventory value and potential impact susceptibility of the inventory value and the potential impact on the company's continued operations. So with that, let's take a look now at question number 14, and again a rather lengthy question body. Unit Corporation has had significant negative cash flows during the current year. Management has been able to obtain additional capital funding for the following year and has a plan to change operations to create a positive cash flow, which has been disclosed in the footnotes to the financial statements. The auditors reviewed the documentation from the additional capital sources and management's plan to reverse its negative cash flows. Based upon the auditor's review, the auditor concludes management's turnaround plan would likely succeed. The auditor has also concluded that, taken as a whole, the financial statements are indeed fairly stated. The auditor would most likely select which of the following reports. So again, if you follow the information, the logic from the previous reports, you should be able to eliminate a couple of those answers right off the bat. Again, stop your video, and when you've arrived at your own answer, go ahead and restart your video. Okay, the answer to number 14 would be, okay, again, the question is, the auditor has concluded that, taken as a whole, the financial statements are fairly stated. The auditor would most likely select which of the following reports, and the answer in this case is B, an unmodified opinion with an emphasis of matter paragraph explaining management's plan for the cash turnaround. And again, if you use the logic we've used in the past couple of questions, again, one of the keys is that the question body does talk about that the client's financial information is fairly stated within the appropriate financial reporting framework. So this is going to result in an unmodified opinion. So that again eliminates C and D. So in this case, the body of the question also refers to the fact that management has described in the footnotes, fully described in the footnotes, their obtaining of additional capital funding and disclosed their turnaround plan. So in this case, this would be an unmodified opinion with an emphasis of matter, since the paragraph, since the information is being disclosed in the financial statements. Now, as I say here, since the auditor has concluded the company's financial statements, taken as a whole, are fairly stated, there would be no need for a qualified or adverse opinion unless the auditor found that the additional capital financing and turnaround plans to be inadequate. That could be possible, but it doesn't say that in the question body. As a matter of fact, the auditor believes that these will be successful, these plans. Under the circumstances, the auditor would most likely issue an unmodified report with an emphasis of matter paragraph referring to the information in the footnotes regarding management's turnaround program, with which the auditor concurs. Let's take a look at question number 15. Question number 15, the auditor includes an emphasis of matter paragraph in an otherwise unmodified report when the entity being reported on has significant transactions with related parties. The inclusion of this paragraph is, and again, you're given 4 different choices. So go ahead and, as you're reviewing your choices, stop the video, and when you're ready to look at the answer, go ahead and restart the video. Okay, let's look at the answer to question number 15. When we do say the inclusion of this paragraph, D, is appropriate and would not negate the unmodified opinion. If we take a look at answer A, is considered a qualification of opinion. In this case, we're saying basically it's an unmodified report, so there is no qualification of opinion. B, violates auditing standards if this information is already disclosed in the notes of the financial statements. And that isn't true, because we know an emphasis of matter paragraph is utilized to refer to the information in the disclosed in the financial statement. So that is basically not in violation. We take a look at C. Necessitates a revision of the opinion paragraph to include the phrase "with the foregoing explanation," and we do not do that. The unmodified report remains unmodified, and the audit opinion doesn't say "with the foregoing explanation." Okay, with that, let's go to the last question of this set, which is question number 16. An emphasis of matter paragraph is used in the auditor's report to draw the user's attention to, and again, we're given our 4 choices. Go ahead and stop your video, and when you made what you feel is your correct choice, go ahead and restart the video again. Okay, question number 16. An emphasis of matter paragraph is used in the auditor's report to draw users' attention to, and the answer in this case is D, a matter appropriately presented or disclosed in the financial statements. And if we go back to the description of an emphasis of matter paragraph, it says it's used to draw the user's attention to information presented or disclosed in the financial statements that is such importance that it's fundamental to the user's understanding of the financial statements. Okay, now let's go on to some more subject matter and go over what we call an overview of the different audit opinions, and they can be a series of audit type of opinions. And what we can see here is there's basically 4 major type of opinions in a subcategory, some subcategories. So let's go ahead and talk about each of these opinions in general terms. Okay, typically what the client's going for is the issuance of what we call an unmodified opinion. And what that means is it's the auditor's opinion that the financial statements as a whole are presented fairly in all material respects in accordance with whatever financial reporting framework has been accepted by the auditor and implemented by the client. And what we can see here is you can see a copy of what we call the unmodified opinion. It's pretty standard. In our opinion, the consolidated financial statements referred to above, that would be in the introduction paragraph again, present fairly in all material respects the financial position of ABC companies and its subs as of December 31st, X1 and XO, and the results of their operations and their cash flows for the year then ended with accounting principles generally accepted in the United States of America. Now, as we talked about, if there's an unmodified opinion based upon whether or not items are included, certain disclosures may be included in the financial statements or the footnotes to the financial statements, or if they haven't, the auditor may want to put in an emphasis type of paragraph, which would occur basically after the audit report to provide emphasis to a particular matter. So the auditor may choose to include or be, in some cases, be required to include an emphasis of matter or other matter paragraph in the auditor's report. Okay, now let's go on to the next type of report, and it's called a qualified opinion. Now in this case, it's a conclusion. The auditor is writing a conclusion that says, except for, okay, very important, except for the matter described, basically, in other words, except for some matter the auditor has identified, and that'll be described in what we call the basis for the qualified opinion paragraph. So a conclusion that except for the matter that the auditor is describing in the basis for the qualified opinion paragraph, the financial statements are presented fairly in all material respects in accordance with, again, the financial reporting framework. So this is an except for, saying basically everything's okay except for this one item or this set of items. Now, there are uh, two different situations where the auditor can end up issuing a qualified report. And that will be where the auditor obtains sufficient appropriate evidence. In other words, they can prove it, has obtained sufficient appropriate evidence and concludes misstatements, individually or aggregated, are material but not pervasive. Now, we've got a couple new ideas here in this particular sentence. The first one is why I say concludes misstatements individually or aggregated. You can have a set of misstatements in the financial statements, and individually they may not be material. They may not be important. However, if we aggregate them, they may aggregate to a material amount. So we have to consider that. Then we say our individually or aggregated are material, which we know the definition for material, but then we have but not pervasive. Now, pervasive is kind of a new term from our perspective, and we will get into the word what pervasive really means in the next several slides. But pervasive for our purposes right now means it's kind of throughout all, not only, it's throughout an entire financial statement, or the misstatements are not only in one financial statement but are pervasive through all the financial statements. So again, what we're saying is has obtained sufficient appropriate evidence, can prove, in other words, and concludes misstatements individually or aggregated are material but they're not pervasive. So again, materiality and pervasiveness do not mean the same thing. Okay, then the second instance of issuing a qualified opinion, and sometimes this is a little bit harder to understand, but it is basically when the auditor is unable to obtain sufficient appropriate evidence. In other words, they can't prove it, but the auditor is going to conclude misstatements individually or aggregated are material but they're not pervasive. In other words, the auditor doesn't have enough proof, but the auditor pretty much believes that there are certain items that are probably are out there that are material, could be material in the financial statements, but they're not pervasive. That could also result in a qualified opinion. We'll get more into that as we go along. The next opinion is an opinion that most people, most clients don't really want to see. It's called an adverse opinion. And what that means is it's an auditor's opinion, a conclusion that because of the significance of the matter noted in what we call an explanatory paragraph, basis for the adverse opinion paragraph. Basically, because of the significance of the matter that the auditor notes, the financial statements contain material misstatements that are also pervasive. The financial statements contain material misstatements that are also pervasive. So that's an adverse opinion, and that's something that a client really doesn't want to see. The auditor can also issue what we call a disclaimer of opinion, and that is the conclusion that because of the significance of the matters described, basically in the basis for the disclaimer of an opinion. In other words, the auditor will write a reason as to why they're disclaiming the opinion. So the conclusion that because of the significance of the matters described in the basis for the disclaimer of audited opinion, the auditor has not been able to obtain sufficient appropriate audit evidence to really form an opinion. Now, a disclaimer of opinion in many cases is almost as bad as an adverse opinion because it's literally saying the auditor suspects something. The auditor either probably suspects something is wrong, but they don't have enough information to reach a conclusion. So with that, then let's dive down into the term of pervasiveness and pervasive effects on financial statements. Now, I know I've used the word E as effect and A as affect. I switched it around a couple of times. I apologize about that in advance, but let's not let that hold us back. Now, to understand pervasiveness, now, the effect of a misstatement in financial statements is material when information with such misstatement can affect the decision of the users of the financial statements. And we talked about that early on as part of a definition in terms of material misstatement. Now, a material misstatement itself can result from a number of different situations. Number one, inappropriate selection or application of accounting principles or policies. Inappropriate presentations of financial statements, including the notes. Inappropriate or inadequate disclosures, and also omissions of required disclosure. Now let's bring in pervasiveness here. A material level of error will be considered pervasive. Okay, will be considered pervasive if it is not confined to specific elements. And when we say elements, those are different line items on a financial statement. So is not confined to specific elements, accounts, or areas of the overall population of the transactions reflected in the financial statement. So it's not confined to one, it's not confined to, basically one or two areas, even though it's material. Okay, it could represent a substantial portion of the statements or the information in the statements if the misstatement is still confined to specific elements, accounts, or items. And lastly, a material level of error is pervasive in relation to disclosures which are fundamental to the user's understanding of the financial statements. So pervasive really means something can be material, but if it isn't pervasive throughout the financial statement in which it's located, or pervasive throughout the financial statements as a whole, basically it may not be considered to be, it may be material, but it's not considered to be pervasive. And on the other hand, though, if it is a material item and it affects large portions of a single financial statement, or it affects major portions of multiple financial statements, it's probably considered pervasive. Now, if we talk about the relationship of material misstatement and pervasiveness, we can say this, and it's pretty obvious once you understand the term pervasive. A material misstatement may not be pervasive, and a misstatement that is pervasive is not always material. In other words, they can be mutually exclusive, and they can also be mutually inclusive. Okay, now let's take a look at when the auditor has to issue or issues a qualified opinion. And this is a qualified opinion in general. And remember, right now we're talking about qualified opinion means except for. So the auditor may issue a qualified except for opinion if the auditor has been able to obtain sufficient appropriate audit evidence and concludes that the misstatements, individually or aggregated, are material, but they're not pervasive, okay, to the financial statements. Now, we talked about the different components or the different sections of the audit reports, and if this occurs, if we have to have an except for report, which is in a qualified opinion, we have to make some changes, and changes to the audit report sections. Okay, the auditor, under the auditor's responsibility sections, it ends with the sentence, "Now, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a reasonable basis for our now qualified audit opinion." Not audit opinion, but now it's qualified audit opinion. Remember that the basis for qualified opinion has to be titled. So the basis for qualified opinion paragraph must be titled, and it must be inserted before the opinion. I'm showing over here, this is an example of of a of a situation where the auditor is issuing a qualified opinion. The reasons for the qualification must be in the basis paragraph, and the basis paragraph should not refer to any explanation in the footnotes to the financial statements. The basis opinion should be able to stand on its own. And actually, the basis of the qualified opinion can refer to the footnotes, but it still has to stand on its own. In other words, everything that needs to be described, even though if they're in the footnotes, they also have to be described in the basis for the qualified opinion. Now, the financial statements may be fairly presented except for the effects or possible effects of a certain matter. If the opinion is qualified because of such effects, the auditor should describe the matter resulting in the qualification. So if we take a look at this example of a basis for qualified opinion. Okay, in this case it says the company has stated inventories at cost in the accompanying balance sheets. Accounting principles generally accepted in the United States of America require inventories to be stated at lower of cost or market. If the company stated inventories at the lower cost or market, a write-down of X dollars would have been required as of the years audited here, December 2000 X1 and XO respectively. Then accordingly, cost of sales would have been increased by a certain amount for both years, and the net income, income tax, and stockholders' equity would have been reduced by certain amounts in those years. So that would basically be the basis for the qualified opinion. And again, that's before we actually issue the opinion. When we issue the opinion should be titled as qualified opinion and should refer to the basis for qualification paragraph above. So here it says, in our opinion, except for the effects of the matter described in the basis of qualified opinion paragraph, right here, the financial statements referred to above present fairly in all material respects the financial position of ABC Company. Now, audit standards also allow the auditor another avenue. The audit standards can say that instead of issuing a qualified except for type of an opinion, the auditor may choose to withdraw from the engagement. Now, I'm not saying it's not saying the auditor should, but the audit standards say that the auditor should consider that as one of the options as opposed to issuing a qualified opinion. So that's what we mean by when we have a qualified opinion with basically with the except for clause. Okay, now let's go on and take a look at another form of qualified opinion, and it's called a disclaimer of opinion. And in this case, it's possibly material, but it's not persuasive. Or sorry, but it's in other words, it's a material misstatement, but it's not necessarily pervasive. Now this particular qualified opinion that results in a disclaimer of opinion is a little bit more tricky to understand. So let's go over the definition or the explanation here. An auditor may issue a disclaimer of opinion, which again is a qualified opinion. So the auditor may issue a disclaimer of opinion if the auditor is unable to obtain sufficient appropriate evidence because of some type of limitation. So the auditor can't come up with enough evidence to reach a conclusion. However, the auditor may conclude the possible facts of undetected misstatements may be material but not pervasive. So the auditor, when I say the auditor may conclude, maybe a better way of saying it is the auditor has the impression, but the auditor can't form an opinion that that possibly there could be undetected misstatements that may be material but not pervasive. Uh, Now, the inability to obtain sufficient appropriate evidence that is material but not pervasive may result from a number of situations, and I have them some included, but it's not limited to these. Number one, circumstances that are not controlled by the entity, such as the destruction of accounting records. And number two, circumstances related to the nature or timing of the work. And number three, limitations imposed by management. Now again, we have to take a look at the auditor's responsibility section of the of an audit report. And here, the auditor's responsibility section ends with the sentence, because of the matters described in the basis for disclaimer of opinion paragraph, and that'll be the paragraph that's going to appear right before the opinion. So under the auditor's responsibility section, it ends with the sentence, because of the matters described in the basis for disclaimer of opinion paragraph, we are not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. So again, if we take a look at the example here, the basis for disclaimer of opinion paragraph must be so titled and inserted before the audit opinion. And the reasons for the qualification must be in the basis for disclaimer of opinion paragraph. And the basis of a disclaimer opinion paragraph should be able to stand on the own. It shouldn't need to refer to any explanation in the notes to financial statements. So let's take a look at this example where we have a basis for disclaimer of opinion. And again, this is just one example. We were not engaged as auditors of the company until after December 31st, 2000 X1, and therefore we did not observe the counting of physical inventories at the beginning or end of the year. So those are two critical points for the audit. We were unable to satisfy ourselves by other auditing procedures concerning the inventory held at the end of the year, which is stated on the balance sheet at such and such. In addition, the introduction of a new computerized accounts receivable system in the year that we audited the company resulted in numerous misstatements in accounts receivable. As of the date of our audit report, management was still in the process of rectifying the system deficiencies and correcting the misstatements. We were unable to confirm or verify by alternate means accounts receivable, including the balance sheet at basically at a total of so much at the end of the year. As a result of these matters, we were unable to determine whether any adjustments might have been found necessary in respect of recorded or unrecorded inventories and accounts receivable, and the elements making up the statements of income and changes in stockholders' equity and cash flows. So that's a basis for the disclaimer of opinion in this particular case. Now, after we have the basis for disclaimer of opinion, now we have our audit opinion, the disclaimer of opinion. And again, the disclaimer of opinion, the opinion should be titled as disclaimer of opinion and should refer to the basis for the disclaimer of the opinion paragraph. Here's the example. Because of the significance of the matters described in the basis of disclaimer of opinion paragraph up here, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. And again, audit standards also allow the auditor to consider withdrawing from the engagement under the circumstances. It doesn't say the auditor has to, but it says the auditor, if they decide to do that, would not be in violation of audit standards. Okay, let's go on and now talk about an adverse opinion. Now, an adverse opinion, if we look at basically is when items in the financial statements are not only material, but they're also pervasive to the financial statements. Now, the auditor may issue an adverse opinion when the auditor is able to obtain sufficient appropriate audit evidence. In other words, the auditor has proof, has the evidence that the auditor concludes that the misstatements, individually or aggregated, are material and pervasive. Again, if we take a look at the auditors, in terms of the paragraph that contains the auditor's responsibility, the auditor's responsibility section ends with the sentence, "We believe that the audit evidence we have obtained is sufficient and appropriate to provide a reasonable basis for our adverse audit opinion." So we have an example over here of basically the format for an adverse audit opinion. And the first thing we're going to do is we're going to insert before the adverse opinion the basis paragraph, the basis for adverse opinion. And the basis for adverse opinion paragraph must be so titled, and it is inserted before the opinion. Also, the reasons for and I shouldn't say qualification, but the reasons for the adverse opinion must be contained in the basis for the adverse opinion paragraph. And the adverse opinion paragraph should not need to refer to any explanation in the notes to the financial statements. The basis for the adverse opinion should stand on its own. Now, if it may refer to items to notes in the financial statements, but by the same token, it still has to stand on its own. Okay, now if misstatements relate to specific amounts in the financial statements, the auditor should include a description in the quantification of the financial effects if that's practical. If it's not practical to quantify the effects of the financial statements, the auditor should state so. So let's take a look at, in this case, the example, the basis for the adverse opinion. As described in Note X, the company has not consolidated the financial statements of subsidiary XYZ Company that it acquired during the year audited because it has not yet been able to ascertain the fair values of certain of the subsidiary's material assets and liabilities at the acquisition date. The investment is therefore accounted for on a cost basis under generally accepted accounting principles, or under accounting principles generally accepted in the United States of America. The sub should have been consolidated. It is controlled by the company. If it is controlled by the company, had XYZ Company been consolidated, many elements in the accompanying consolidated financial statements would have been materially affected. The effects on the consolidated financial statements of the failure to consolidate have not been determined because the auditor could not determine what those effects were. So that leads into our adverse opinion, and the adverse opinion should be titled as adverse opinion and should refer to the basis for the basis for the adverse opinion paragraph. And it goes on to say, in our opinion, because of the significance of the matter discussed in the basis for the adverse opinion paragraph, the consolidated financial statements referred to above do not present fairly the financial position of ABC Company and its subsidiaries as of, and then we go such and such. Again, the audit standards also allow the auditor to consider withdrawing from the engagement if the auditor considers that to be an appropriate reaction. Okay, there's another situation, again, which can result in a disclaimer of opinion. And that's basically the auditor may issue a disclaimer of opinion if the auditor is unable to obtain sufficient appropriate evidence because of some form of limitation, and the auditor concludes that undetected misstatements could actually be material and pervasive. And again, I've listed the three circumstances where this it's not limited to these three circumstances, but three circumstances where this can occur. The inability to obtain sufficient appropriate evidence that is material but not pervasive may result from, number one, circumstances not controlled by the entity, such as the destruction of accounting records. This is basically where we have the same issue regarding with the other type of disclaimer of opinion, where we couldn't come up with a sufficient appropriate evidence. Circumstances related to the nature, timing of the work, and lastly, limitations imposed by management. We go back to parts of the audit report. Here there are two sections that we need to consider restructuring. Number one, the auditor's introductory paragraph starts with "we were engaged to audit" instead of "we have audited," because we were not able to audit it. We couldn't get sufficient appropriate evidence. The other section is the auditor's responsibility section, just like all the other sections that we've talked about. The auditor's responsibility section ends with the sentence in this case: "Because of the matter described in the basis for disclaimer of opinion paragraph, we were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion." So again, the basis for the disclaimer of opinion paragraph should be that it's referring to here should be put in front of the disclaimer of opinion, in effect the auditor's opinion, which is a disclaimer of opinion. So you have to put the basis for disclaimer of opinion first. The reasons for the qualification, or in effect the reason for the basis of disclaimer of opinion paragraph, should not need to refer to any of the footnotes in the financial statements. It should stand on its own. Now let's go through this particular example. We were not engaged as auditors of the company until after December 31st, and therefore we did not observe the counting of physical inventories at the beginning of the end of the year. We were unable to satisfy ourselves by other auditing procedures concerning the inventory at December 31st, which is stated in the balance sheet at such an amount of money. And again, this is the same basis of disclaimer of opinion that was in the previous example. It can be used in both cases. In addition, the introduction of a new computerized accounts receivable system in September 2000 X1 resulted in numerous misstatements in accounts receivable. As of the date of our audit report, management was still in the process of rectifying the system deficiencies and correcting these misstatements. We're unable to confirm or verify the alternative means accounts receivable included in the balance sheet and total amount of XXX at December 31st, 2000 X1. As a result of these matters, we were unable to determine whether any adjustments might have been found necessary in respect or recorded or unrecorded inventories and accounts receivable and the elements making up the statements of income, changes in stockholders' equity, and cash flows. Okay, now we get to the disclaimer of opinion paragraph. And in this case, again, the opinion as it is should be titled as disclaimer of opinion and should refer to the basis for disclaimer of opinion paragraph as the basis for the disclaiming of the opinion. And as it says here, because of the significance of the matters described in the basis for disclaimer opinion paragraph, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. Now, in this case, again, this is when we don't have enough evidence, but we feel that the auditor concludes or feels that the potential undetected misstatements could still be material and pervasive. We issue this disclaimer of opinion. And again, the audit standards give the auditor an out in terms of the auditor may decide to withdraw from the engagement. Now let's take a look at a 10,000 foot overview of what we've just talked about. And here we have a matrix of the summary of factors influencing the auditor's application of a qualified opinion, an adverse opinion, and or a disclaimer of opinion. And again, here we have the different type of opinions based upon reasons for the modification of the audit report and the auditor's judgment about the pervasiveness of the effects or possible effects on the financial statement. So as an example, if we find out if we basically have concluded that financial statements are materially misstated, however, they're not, we find that the auditor feels that the auditors concluded that yes, the statements are materially misstated, but they're not pervasive. The auditor is going to issue what we call a qualified or an except for type of conclusion. On the other hand, if financial statements are materially misstated and the auditor concludes that the audit or the financial statements themselves are not only material misstated, but the material misstatements are pervasive, the auditor is going to arrive at an adverse opinion. Now, we can also be where the auditor has not been able to obtain sufficient information, sufficient proof, and if the auditor feels the financial the sufficient proof to reach a formal conclusion. So if the auditor feels that the financial statements could have material misstatements, but they're not pervasive, the auditor will issue a qualified opinion. If the auditor feels that the the auditor does not have enough evidence to basically conclude that the financial statements not only contain, the auditor may conclude that the financial statements potentially have errors that could be material and pervasive, but the auditor has no proof, sufficient proof of that occurring, the auditor can issue or will issue a disclaimer of opinion. And as I mentioned, all the audit standards in all these instances also say that the auditor can go ahead and, or if they wish, or if they wish or they're able to withdraw from the engagement, there would be no violation of the professional audit standards of the auditor. Now with that, let's take a look at question number 17. And in this case, the auditor may express a qualified opinion for which of the following reasons. And again, you're given 4 reasons. Go ahead, do review and stop the video as you do review. And when you're ready for the answer slide, go ahead, restart the video. Okay, let's take a look at the answer to question number 17. And what we see here again is the auditor may express a qualified opinion for which of the following reasons. And there's 2 major reasons here: circumstances related to their work and limitations imposed by management. So what this is saying is these are circumstances that during the audit, for some reason, the amount of work they could do was not sufficient or appropriate. And in this case, limitations imposed by management would be basically limitations that limited the scope of the audit, so they couldn't come up with sufficient and appropriate type of work. So if you look at that circumstance here, we see the, okay, reason for modification. Then we have to basically say, okay, is it because the financial statements are basically that, can we come up with the evidence, sufficient appropriate evidence, or do we have the inability to obtain sufficient and appropriate audit evidence? So in this case, it's asking basically what, in the case of a qualified opinion, which particular circumstances would that relate to? And if you can see here with the circle down here, that's basically both these items relate to the inability to obtain sufficient and appropriate audit evidence. So this would result basically in a qualified opinion. So the answer would be yes for A, because it pertains both the circumstances related to work and the limitations imposed by management. Let's try question number 18. Question number 18, the auditor decides to express a qualified opinion on an entity's financial statements because a major inadequacy in its computerized accounting records prevents the auditor from applying the necessary and effect audit procedures. The opinion paragraph of the auditor's report should state the qualification pertains to, and we have these four particular situations. Again, go ahead and review perform your analysis, stop your video, and when you're ready, restart the video to review the answer. Okay, the answer to question number 18 is basically, it says again, the opinion paragraph of the auditor's report should state the qualification pertains to, and it would be, the answer in this case would be C, the possible effects on the financial statements. When an auditor qualifies their opinion as a scope limitation, the wording in the opinion paragraph should indicate the qualification pertains to the possible effects on the financial statements and not the scope limitation itself. Okay, with that, let's go ahead and try question number 19. Question number 19, assume that the opinion paragraph of an auditor's report begins as follows. With the explanation given in note 6, the financial statements referred to above present fairly. This is, and it asks you to determine what type of an opinion this would be part of, or is it an improper type of reporting. So go ahead and review, select your answers, stop your video. When you're ready, restart the video to review your answers. Okay, the answer to question number 19 in this case is D, an improper type of recording. Sorry, not recording, reporting. So in this case, with the explanation given in note 6, that it doesn't give the reader of the report a clear-cut indication of the auditor's, the reason for the auditor's opinion. Again, that has to appear, that note basically has to stand alone in the basis for the qualified opinion paragraph. So this phrase here appears to modify the modify that standard opinion paragraph, but it doesn't have enough, as I say here, it's not forceful enough to constitute qualifying language. It doesn't provide enough information for the qualifications, what I'm saying. So if we look at our qualified opinion, it would state something to this effect. In our opinion, except for the effects of the matter described in the basis for the qualified opinion paragraph. So what that means is that basis for qualified opinion paragraph has to have a very complete explanation as to why we're qualifying the audit report. Okay, now let's look at question number 20. Question number 20. An audit report for a public client. Okay, now when we say public client, that's publicly traded, or they can also say listed client or SEC registered client, something along those lines. So an audit report for a public client indicates that the audit was performed in accordance with, and again, you're given 4 choices. Go ahead and analyze them, come up with your own answer, and as you do that, stop the video, and when you are ready with your answer, please restart the video for the answer slide with the explanation. Okay, let's take a look at the answer to question number 20. An audit report for a public client indicates that the audit was performed in accordance with. In this case, since it's the audit of a public client, it would be performed within the standards set by the Public Company Accounting Oversight Board, the PCAOB. And I refer you back to one portion of our presentation in class where we talked about the PCAOB auditor report. This is issued when the audit is performed by, again, publicly traded companies. And one of the differences compared to the PCAOB audit report as opposed to the differences for generally accepted auditing standards, it includes reference, it references the standards of the PCAOB rather than generally accepted auditing standards, which are issued by the AICPA. And I've reproduced an example of at least a portion of an audit report that came from Southwest Airlines back in 2012, and you can see where it says that in this circled area. We have conducted our audits in accordance with the standards of the Public Company Accounting Oversight Board. So that is the answer to number 20. So let's try the last multiple choice question in our video, which will be question number 21. What type or types of audit opinion are appropriate when financial statements are materially and pervasively misstated? And we're given 2 types of audit opinions. We're given qualified opinion and an adverse opinion. So go ahead and look at the 4 situations, and based upon your analysis, come up with what you feel is a correct answer. And when you're ready to restart your video, go ahead and review the answer slide to question number 21. The answer to question number 21 is C, where we're saying it is in the case of a qualified opinion, first of all, what type or types of audit opinion are appropriate when financial statements are materially and pervasively misstated? Okay, with this chart, it's actually pretty easy to do if you memorize it. First of all, it says which type of financial statement, what type of audit opinions are appropriate when the statements are material and pervasively misstated. If we take a look at this, what I call the 10,000 foot matrix here, you can see material and pervasive misstatement. Okay, there's only 2 conditions the auditor will issue one of these statements, and basically that's when financial statements, we don't necessarily have the proof the financial statements are materially misstated. We'd issue, or we do have the audit proof that the financial statements are materially misstated. That would result in an adverse opinion. The other situation is the disclaimer of opinion, where there is where the auditor does not necessarily have the proof to prove that the statements are material and pervasively misstated. Now, under those conditions, we'd have to have, if we had adverse opinion and disclaimer opinion, those would both be yes. Okay, we can see here that adverse opinion does appear, and that would be a yes. So we have two items that we can choose from, A and C. Now we notice here that in terms of basically it's asking would this be appropriate under a qualified opinion, and since qualified opinion doesn't fall under adverse or disclaimer, that would be a no. So in this case the answer would be C, yes for adverse and no for qualified. And that should be the end of our video tonight, and thank you so much for your time.